This is your teacher Harris. When you are seeing my YouTube channel and accounting with Sir Harris. Today we are going to solve a question from AS Accounting 9706, and marginal costing is the topic. But we are basically solving a question of absorption and marginal costing income statement. This is a proper topic which comes as a last part of the marginal costing, where we have to prepare a profit statement in this question for each of the months, August and September, using absorption costing and then using marginal costing and then reconciliation. I will go with marginal costing first. This question has come in October, November 23, 21, question 4. October, November 23, 21, question 4. This is the last time this topic has come after 2 years, because previously it has come in 21, then 23, and both times it has come in October, November 21, 23, and maybe it will come now in October, November 25. So in May, June, it has not necessary that it will come, but it might come also in May, June 25. So Javed manufactures a single product. He currently uses a system of absorption costing, but is considering changing to margin costing. The following budget information is available for 1 unit of the product. Selling price is 18, direct material 7, direct labor 5. It means, and budgeted production is 12,000, and budgeted fixed overhead is 36,000 per month. The first thing which we do in solving these questions, we need to find the per unit cost. Per unit cost according to absorption costing and per unit cost according to marginal costing. So if we talk about marginal, the per unit cost is going to be only the variable cost, and that is going to be 7 plus 5, and it is 12. But if we talk about absorption, the per unit cost also includes production per unit cost also includes fixed cost per unit. 7 plus 5, and the fixed cost per unit is budgeted fixed overhead cost divided by budgeted units, that is 12,000. So that is 3. So 7 plus 5, 12, 12 plus 3, 15 is the per unit production per unit cost according to absorption cost. And now we will start question first by solving the question through marginal costing or preparing the profit statement under marginal costing. So let's start doing it. I will write here marginal cost statement, and I will write here the dollar sign, and I will write here first of all the revenue. Revenue means sales. Let's go back to the question. Revenue is given, selling price is 18, and if you talk about that, we have to, at 1st August, Javed had no inventory, so there is no opening inventory available in the question. But if you talk about production is 10,000 units and sales is 8,000 units. So production units are 10,000 and we have sold 8,000. It means that 2,000 is the closing inventory, and that closing inventory will become the opening inventory of September. We have produced 10,000 and all 2,000 plus 10,000, all 12,000 units have been sold in September. So we have to prepare the marginal cost statement for both August and September. So let's do that. This is for, let me write here because I don't have the space. Let's check it again. August and September. Okay. So I will write here August. This is for August. And this is going to be for September. Okay. Let's prepare that. So revenue, first we'll discuss about the revenue. The revenue is going to be 8,000 units, which is the revenue multiplied by that price for each unit is 18. The selling price is 18. So can you please tell me 8,000 into 18, what is the sales amount? 8,000 into 18. So what is going to be the sales?
144,000.
Okay. So the sales for August is going to be 144,000. Okay. I can write the sales for September also. The unit sold for September is 12,000. Here it is written 12,000, right? And let me show you here. September, the unit sold is going to be 12,000 and the selling price per unit is still the same, which is 18. So what is the sales for September? Can you tell me 12,000 into 18? What is the amount?
So 216,000.
216,000. Now let me do something. Let me prepare the columns actually so that you might not mix it up with each other. No problem now. Okay. Now we can do that because the left hand side is basically for August, and I believe that the right hand side is for September. Although we are preparing the state marginal cost statement, but still I have to write it that way. So what I will do, as we are preparing marginal cost statement, we will subtract less variable cost of sale. Fixed cost will not be included in that because from revenue we'll subtract variable cost of sale, and it includes opening inventory, add production cost, and less closing inventory. Sir, what we are doing, this is something very new for us. Yes, that's true. Why, sir? Because in this particular question, we have not been given, we have been given the direct material and direct labor costs, but we have given inventories also. So how come you know? In August, we have produced 10,000 units, but we have sold 8,000 units. It means 2,000 is the closing inventory of August. And the same closing inventory of August will become the opening inventory of September, 2,000. And we have produced 10,000 units in September and all are sold. So August, we have no opening inventory. And in September, we have no closing inventory. In marginal costing, we take only direct cost or variable cost as product cost. So per unit cost under marginal is going to be 7 plus 5, 12. But per unit cost under absorption should include fixed element also. So fixed cost per unit is budgeted fixed cost is 36,000 and budgeted production is 12,000. So fixed cost per unit is 3. So 12 plus 3, 15 is the per unit cost under absorption costing. But currently we are preparing only marginal cost statement. There is no opening inventory, production cost. I will calculate how many units have been produced. Let's check it out. For August, actually, that is 10,000. For both 10,000, actually. So 10,000 into, I will write here, 10,000 units multiplied by per unit cost under marginal is 12. I will multiply it with 12. So the amount is going to be 1,20,000 less closing inventory. Closing inventory is 2,000 multiplied by 12. So that is going to be 24,000. So can you subtract it? What is the answer? 120,000 minus 24,000. That is going to be 96,000. So that will be our 96,000 is the variable cost of sales for August. Now you will subtract 96,000 to get the amount of contribution. So what is the amount of contribution here? 144,000 minus 96,000. What is going to be the amount of the contribution? 144,000 minus 96,000. This is 48,000. Oh, sorry, 48,000 less fixed cost. I will subtract fixed cost from it. This and fixed cost is given in the question, that is 36,000. So I will write here 36,000. So how do you know the fixed cost is 36,000? Let's see. Budget fixed cost is also 36,000 and the fixed overhead cost given for August and September is also 6,000. So budgeted and actual fixed costs are the same, but we will subtract actually, we have to subtract actually budgeted fixed overhead cost, not actual, because fixed cost does not change with the change in the volume of production. Either we are producing 10,000 units, 10,000, 12,000, 18,000, 12,000, fixed cost will remain 36,000. I will subtract 36,000. So the answer is the profit for the year. And that is going to be how much? 12,000 is the profit. Sorry. Profit for the year under marginal costing for August. Now let's talk about September. There is opening inventory in September because the closing inventory of August will become the opening inventory of September. Production cost will remain the same because 10,000 into 12 is the production cost. There is no closing inventory. So the variable cost of sales for September is going to be 24,000 plus 120,000, that is going to be 144,000. So 2,16,000 minus 1,44,000 will get the contribution. That is 72,000 minus fixed cost, that will remain the same, 36,000 for every month. And the answer is going to be 36,000 is the profit for the year for under marginal cost statement. Now, I'm going to prepare the same thing again for under absorption cost. So let's prepare that. I will open a separate print shop because I have to solve the question again under absorption costing statement. Always remember that this type of question, when this type of question will come, you will be able to know that. How come, sir? I will tell you. Number one, you will be asked to prepare both marginal cost statement and absorption cost statement. Number one. Number two, inventories will be given in the question. I have never solved a single question in front of you where inventories are given in the question. Opening or closing, anyone. But here you will be having inventories given in the question, either opening or closing. Then you have to remember this, that this type of question has come in marginal costing. Then you have to cope with this through this method. Again, you will start preparing the statement in the same manner, right? You will write sales. Sales will remain the same. You have sold how many units? That is 8,000 and 12,000. So 8,000 multiplied by sales will remain the same into 18 and 12,000 into 18. So let's go back. I can write from here also. 8,000 into 18, 144,000 and 216,000. It will still be the same in under absorption costing. 144,000 and 216,000. Okay, now I will subtract less cost of sales. It will not be variable cost of sales. It is going to be cost of sales. And the per unit cost we will take, it will not include direct material, direct labor, but also fixed overhead cost per unit will also be part of product cost. Why, sir? Because absorption costing says that overhead cost should be a part of product cost. Absorption costing says that overhead cost should be a part of product cost. So that is going to be 15. So let me write down all the things now. Opening inventory, add production cost less closing inventory. So let's write it down now. If we solve this question, the opening inventory is not there because production is 10,000. So there is no opening inventory given in the for August. Production cost I will calculate. Let me calculate here because I have less space written over there. That is 10,000 units have been produced and the production cost each unit under absorption is 15. This is going to be 1,50,000. Then the closing inventory, the units are 2,000, but the cost per unit is 15 under absorption cost. So that is going to be 30,000. So I will subtract 30,000. So I will get the amount. Just a minute. So I'm going to get the amount of how much? 1,20,000. Okay. Now let's move forward. For this, the same closing inventory will become the opening inventory of September. That is 30,000. Add production cost 10,000 into 15. That is going to be 1,50,000. And less closing inventory, there is no closing inventory. So the amount is going to be 1,80,000. So I can find the answer, which is going to be my gross profit. 144,000 minus 20,000, 24,000 is the gross profit. And 216,000 minus 1,80,000, that is 36,000 is going to be the gross profit. Now, less fixed cost? No, because demand fixed cost is already being taken into account when we have calculated production cost and cost of sales. Because production cost includes an element of fixed cost, which is basically per unit, 3 per unit. It is part of 15. Over here is also a part of 15. So both will already added in that. So sir, what is the problem now? Problem is this, that I have to find something different. What is? That is going to be actual overheads or the overhead should be written for August and September should be 36,000, because fixed cost does not change with the change in the volume of production. Actual fixed cost is also 36,000, but we will take actually budgeted fixed cost. All fixed costs should remain the same. It is 36,000 again. And we compare it with the absorbed overhead cost. Absorbed overhead cost, but we have absorbed 10,000 units, and the overhead cost per unit or OAR per unit is 3. So we have basically added 30,000 in the cost of sales as absorbed overhead cost in both cases, in August also and in September also. So it means that we should have written actual overhead cost 6,000, but we have written 30,000, so that is going to be under absorbed by 6,000. So in both cases, you have recorded production cost, and the fixed cost included in the production cost is 10,000 into 3, which is 30,000, which should have been 36,000. So it means in both production costs, 6,000 fixed cost is recorded is undercast, right? Undercast means cost of sale is undercast by 6,000. Cost of sale कम होगी 6,000 से, और जीपी 6,000 से क्या हो गया बेटा, ज्यादा हो गया. तो हम यहाँ पे लेस कर देंगे अंडर एब्सॉर्ब ओवरहेड्स. ये आपको लिखना पड़ेगा. यहाँ भी आ जाएगा लेस अंडर एब्सॉर्ब ओवरहेड, which is going to be 6,000, because of that our production cost is less by 6,000 अंडर एब्सॉर्ब. इसकी वजह से कॉस्ट ऑफ सेल कम हो गई, जीपी ज्यादा होगी, और यहां भी आपको 6,000 क्या करना पड़ेगा, माइनस करना पड़ेगा. नाउ यू विल गेट द प्रॉफिट अकॉर्डिंग टू एब्जॉर्प्शन कॉस्टिंग, which is over here 18,000, and for this it is going to be, for September it is going to be 30,000. So this is the point which we haven't solved in the last class for yesterday. I've done it over here also. There is another method. What? That this 1,50,000, in this we have recorded this production cost 6,000 less. तो आप इस 1,20,000 में कॉस्ट ऑफ सेल में 6,000 ऐड कर दें, ऐड अंडर एब्जॉर्ब्ड ओवरहेड्स, तो ये 126 हो जाएगा. 1,80,000 में 6,000 अंडर एब्जॉर्ब ऐड कर दें, तो ये 1,86,000 हो जाएगा. ठीक है, या तो कॉस्ट ऑफ सेल में ऐड कर दें 6,000 दोनों में, या ग्रॉस प्रॉफिट में से माइनस कर दें, क्योंकि उसकी वजह से ग्रॉस प्रॉफिट ज्यादा हो गया है कॉस्ट ऑफ सेल कम होने की वजह से. दोनों ही मेथड अडॉप्ट कर सकते हैं, और अब आपका जो आ जाएगा प्रॉफिट वो 18,000 और आ जाएगा क्या बना, 30,000 अंडर एब्जॉर्प्शन कॉस्ट. बट इफ यू सी द प्रॉफिट अंडर मार्जिनल कॉस्टिंग इज नॉट द सेम, दैट इज 12,000 and 36,000, right? Where in absorption costing the profit is 18,000 and 30,000. So now let's prepare the reconciliation of profit. We'll start with the marginal costing profit for both months, obviously, for August also and for September also. I will write here August and I will write here September. Now what we'll do, why there is a difference between marginal costing profit and absorption costing profit? Why there is a difference? Difference is because of the fixed cost element in absorption costing. Because when we have calculated absorption costing profit, the fixed cost element in production cost was taken as 10,000 into 3, whereas fixed cost should have been 36,000. So how we go for the reconciliation? Marginal costing profit, add closing units into OAR and less opening units into OAR. OAR is the same actually. So is there any closing units in August? Yes, there are. There are 2,000 new closing units are there. And the over absorption rate for each unit is 3. So that is why we are going to have 6,000, which will be added in absorption costing profit. Let me check it out. That what is the absorption marginal costing profit, sorry, which we have calculated. That is going to be 12,000 and 36,000 for August and September. So I will write here 12,000 and 36,000. Okay. And now you can find the absorption costing profit, which is 18,000. Why, sir? Because opening units in August basically are 0 multiplied by 3. So the answer is going to be 0, which obviously has to be subtracted. So we will get the absorption costing profit of 18,000. We are done with that. So from marginal costing, we have found the absorption costing profit through reconciliation. Now let's talk about September. In September, our marginal costing profit is 36,000. Add closing units into ORR, that is 0, because there was no closing units in September. Less opening units into OAR. Opening units are there in September, and they are 2,000 units are there. And the overhead absorption rate for each unit is 3. I can write here 2,000 into 3. That is again 6,000. I will write the total directly. 6,000, and you will get the answer of absorption costing profit, which is going to be 30,000. So this is the reconciliation of profit, which start from marginal costing and will end at absorption costing. Margin 12,000, absorption we have calculated. Now 18,000 is coming. And then again, margin 36,000, absorption is 30,000 over here. So we are done with the reconciliation also, right? It is, you can also do like this, that difference in units. There is another method, which is also known as, you will add it up, difference in units into OAR. So that way also you can calculate. The difference in units mean difference in opening and closing units. But we will use this method. This method we'll use in the MCQs, not here. For here, this is the end of the question. So this is the way we will solve this question. What is the next part of the story? Advise Javed whether or not he should change from absorption to marginal costing. Justify your answer. So absorption costing, there are 7 marks. So you 3 for the 3 points for absorption, 3 points for marginal, or 3 points of positive, negative, whatever you can do, and 1 for the decision. So absorption costing takes into account full cost of production as part of product cost, right? So it is a better measure. It is acceptable in national accounting standards. It is also used for tax purposes, acceptable for tax purposes. And it is a method through which we can calculate the selling price, which is more accurate. It is used for finding the selling price because it takes into account all production cost as part of product cost. But absorption costing basically is the overhead cost included in absorption costing is based on estimated basis, because OAR is calculated by using budgeted data, budgeted overhead cost divided by budgeted. So it is not the accurate cost actually. So that is why it results in under or over absorption of overheads. And because of under or over absorption of overhead, we have to adjust our profit or cost of sales because of that. Right? If you talk about marginal costing, it is not a costing method. It is used for decision making, right? It is used when you want to go for a decision, accept or reject decision, make or buy decision, or accepting an order below normal selling price. And it is also helpful to find break-even and margin of safety and for any decision-making purpose. But it is not a proper costing method and it can't be used to find the selling price. It is also used for CVP analysis, but it is not used to find the selling price, right? So if advised whether or not he should change, no, he should not change his absorption costing method to marginal costing method. As I discussed with you, that absorption costing is acceptable in national accounting standard, and it is also used for tax purposes, and it is the best method we use for inventory valuation. Because for inventory valuation, we should multiply our inventory with all production cost, not with only variable cost of sales. But marginal costing helps to differentiate between fixed cost and variable cost. We can see that what is the variable cost, what is the contribution approach, what is the contribution, and then we can have fixed cost subtracted from contribution to get the profit. So it is used for decision making. So we'll go with the absorption cost, right? Thank you very much. Inshallah, I'll send the more papers to you. Thank you very much. Allah Hafiz. Any question?